Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, we've got something important to talk about today. There is a major event unfolding for the markets this week that deserves the majority of our attention. So we'll discuss that, and the video will be light on on-chain and derivatives as those take a back seat to greater monetary policy concerns. So stay where you are. We've got a couple of points to discuss. If you enjoy this content, please give this video a thumbs up and be sure to subscribe to my channel. And without further ado, let's get into it. So we're sitting here looking at the price chart. It's about 30 minutes into the open in Western markets on this Monday morning. And the first thing I noticed, the S&P is setting a new year-to-date low today. Now it's trying to battle above it. Who knows what will happen throughout the day. But the price has been set. A new year-to-date low has been made on the S&P, which is something the NASDAQ did last week. Now the Dow Jones still has not done that. It's holding up relatively well. And also, Bitcoin is holding up relatively well. Not even close to year-to-date lows for digital coin. And this is an interesting development to me. When we see the Western markets showing weakness, while Bitcoin is providing relative strength, I think it's commendable. It also shows that Bitcoin as the premier risk asset in global markets doesn't always have to be the first thing that loses its shirt. You know, in many cases, it is one of the first assets to start moving when the winds begin to shift. You know, as one of the last remaining free markets that we have, it does tend to move more quickly and more responsively to new events unfolding. But this weakness we see in equities this morning is not echoing over here, and I think that's something worth commenting on. I'm not trying to present some hopium narrative that Bitcoin is decoupling here. That's not my point. But when we see year-to-date lows on indexes, while Bitcoin is nowhere near its own year-to-date lows, that demonstrates a relative strength, and it tells us a little something about Bitcoin's maturity. And you know, this weakness in equities is understandable because tomorrow and Wednesday is the Federal Open Market Committee meeting at the Federal Reserve. That's when they discuss their next plans for monetary policy, the raising of interest rates, and the rolling off of the balance sheet, also known as quantitative tightening. We find out those outcomes on Wednesday, and it makes sense to me that the markets are going to chop around and be very unattractive over the next couple of days until we get a little more clarity on monetary policy. So now that we've set these new lows, chances are we'll create another one. There'll also be some chop back to the upside. And over the next couple of days, I just don't want to have anything to do with the S&P. It is in for absolute chopville. Now, if we hop over and we look at Bitcoin on a monthly chart, this is not an attractive price chart, friends, in my opinion. Now, we know that the price has not been attractive. It's been chopping around for months. But if we're going to talk specifically here, on the monthly time frame, to come down and set a low of the range, come back up to the high, try to break out and be rejected, and then within a single month candle come all the way back down to the lows, that is bearish to me. And it's bearish in a couple of other ways. Now, we didn't break down under this 37.3 level and dance around in support, but we got really close to it. And this candle close right here with almost no wick to speak of is bearish. That means that there was virtually no volume at the lows to step in and push price up. The amount of demand here at the close of this monthly candle was very light. So from this high time frame perspective, we set a big macro range, we climb to the top, we try to break out, we get rejected, and we go to the bottom. Then we set a smaller macro range, we climb to the top, we try to break out, we get rejected, and we go back to the bottom. So I think we're doing what we did on a bigger time frame on a slightly smaller scale down here. I don't know where it leads after this, but I certainly wouldn't want to see us dragging along this 37.3 level, because then that means, or chances are, we're going to dance down here below it. The more times you test a level of support, the weaker it gets. The weekly time frame doesn't look too much better, and where we find ourselves dancing around on support is right over here at what was the first weekly close of 2021. That price level is around 38,200 or so, and it's a place where we gathered support for several weeks in February and March. We find ourselves back down at this level, and if I had to say from a weekly perspective, ideally we don't have candles dancing around down here. This is is a big open space without any real clear support, and I just wouldn't want us to be dancing around down here. Structurally, that would not be great. We could do that without setting a lower low, but we'd be dancing with fire, and that's just not an outcome anyone wants. So ideally, we hold up here around 38,000, but we'll see. Bitcoin has a way of giving the market exactly what it's trying to avoid. So a dance down underneath this level is probably more in the cards than not. Now, from a daily perspective, I don't really want to get too granular on price levels because we just did that on the higher time frames. And from the daily perspective, they're not that much different. I'm still looking generally at this kind of 38 to 40,000 level that we've been stuck in for ages, and we're currently underneath. But no, what I think is interesting on the daily chart at this point in time are these structural parallel channels that we've formed. So here's the first one we formed on the high time frames, and we've respected it about 5 times. It's been touched 5 times, the most recent of which was here at the end of January when we set the year-to-date lows. So we've got this big channel here, and also recent price action has established itself in this smaller channel. And this channel has also, for its part, been tested a handful of times. So we see these levels being respected. And even here over the weekend, we found our way back down to the bottom of this channel. Maybe support holds here, maybe it doesn't. As we explored on the higher time frames, when we get down below this level, there's some open air. So if we were to look at it purely from this daily perspective, and we're using these couple of channels I drew, there is an opening here for us to break down without losing market structure. So what do I mean by that? Well, let's explore this a little bit. If we were to break market structure, in my mind, that would mean breaking below this February low and creating a new lower low down here somewhere. That price is around 34,300. So ideally, price action staying above that level would mean we were continuing to grind up out of the lows. Now, this level is actually underneath the parallel channel. So what that does is it creates room for price to break down out of this smaller time frame channel into this bigger macro channel without losing structural price support. Now, where this channel goes down to is around 35,000, 34,900. Somewhere around in there is that level, and it's rising slowly. So over the next couple of days, when we see this weakness in equities, we see them setting new year-to-date lows. The Nasdaq's already doing that. Chances are the Dow will want to make its way down here and follow the others. That kind of action could lead Bitcoin to kind of trickling downwards. So if that starts to unfold and we actually break down below this channel, there is some room here for price to fall all the way down to around 35,000 and not invalidate market structure. So that's a plan I'll keep in the back of my mind to keep an eye for. If we see things breaking down, it won't immediately mean panic. You know, having price down here, it doesn't mean that it's all over and we're going to 20K like a lot of people think. We can still break down out of this trend without shattering market structure. So that's really my point here. So what we'll be watching for this week is on Wednesday. We'll look for the press conference with Jerome Powell and the Fed Board of Governors. They'll be coming out of their Federal Open Market Committee meeting that takes place on Tuesday and Wednesday, and we will find out the near future of monetary policy. We'll find out if they're going to stick with a 50 basis point rate hike, which I believe they will because it's what they've primed the market for. And we will also finally hear details about their plans to reduce the federal balance sheet, also known as quantitative tightening, which instruments they plan to roll off, and the pace at which they plan to do it. Those details are materially impactful to the market, and it stands to reason that the next couple of days will be incredibly choppy and uncertain until we get more clarity in that regard. Now, all of these meetings with the Federal Reserve have been important, and anyone who's watched my channel for any length of time knows that I find it ridiculous that the whole of global markets and the well-being of all investors hinges upon the words of a dozen unelected officials in Washington. The Board of Governors has incredible sway over markets and livelihoods, and while I find it absurd, it is the reality we live in, so it's important to pay attention to what those people do and say. And this meeting that we are about to see this week is where rubber really begins to meet the road. So for the last several months, Ever since inflation in Q3 and Q4 of last year started getting out of control, ever since then, the Federal Reserve has been priming the markets for absolute hawkishness. And as a result, we've seen a historic sell-off in the bond markets. We've seen all of the indices pulling down 10, 15%, the NASDAQ down 20%. And all of this has played out without the Fed doing much of anything at all. They have raised interest rates a single quarter point, 25 bips. That's all they've done. And everything else has been purely rhetoric and posturing. And they've caused a massive deleveraging. We're already seeing the markets breaking themselves in a lot of ways in response to this hawkish posturing. Now, as we've explored on this channel throughout a number of videos in the last couple of months, I have grave doubts about the Fed's ability to tackle inflation with current debt levels being where they are. They've waited far too long to take this issue seriously, and they have few options available to them. So this meeting on Wednesday, where they start talking with real detail about quantitative tightening, is going to be the most impactful Fed meeting of any in recent memory. Because quantitative tightening, the reduction of assets on the Federal Reserve's balance sheet, is a more impactful market decision than raising core interest rates. Because the bond market has already been selling off. Yields have already risen in the debt markets. But liquidity, the backstopping of liquidity provided by the Federal Reserve, the support to the housing market by the continual holding and reinvesting of mortgage-backed securities, those actions greatly support asset valuations and market growth. And with consumer inflation being as high as it is and GDP growth already reducing, if the Fed comes out with an intent to be aggressive in their pace of quantitative tightening at a pace the market finds uncomfortable, we will see sell-offs in a dramatic way. So I'm very eager to hear what Jerome Powell says on Wednesday, the way he characterizes their plan, and how the markets react to it. Because there are a lot of people out there that believe there is a Fed put on the markets, meaning that if the stock market pulls back to a certain price, that Jerome Powell will step in to save it. But I suspect that the Fed would not be driven to act because of a price on the index. I think they're more beholden to health in the credit markets. And those, while showing signs of weakness, are not yet at a breaking point. So we've got a little bit of weakness in equities like we talked about. Bitcoin is holding up pretty well, all things considered. And because of the importance and impactful nature of the meeting on Wednesday, the policy decisions that come out of it, I don't want to spend time today looking at on-chain or derivatives metrics because I don't feel the signal provided by those data sets will inform the direction of the market over the coming days. It will be decided by monetary policy at the highest levels of government. Those are the most important things to talk about today, friends. My perspective as a longer-term investor is one where I'm trying to understand global market impacts and general direction. And when we have something as significant as the meeting coming up on Wednesday and the potential ripple effects that come out of it, things like open interest buildup and long-term holder supply, etc., are not the place to focus our energy. So that's why we have left them out of today's video. Be sure to follow me on Twitter at TXMC Trades. That's where you'll find a lot of my thoughts and analysis, and I try to interact with folks who comment on my tweets as much as I can. This is an important week for the market. It can't be understated how significant quantitative tightening will be if the Fed continues to move forward with their plans. So I'm eager to find out the schedule and nature of that intent. We will meet again later this week after we get some more clarity about monetary policy and we see how markets begin to react. So stay tuned for another video later this week. If you have any questions or feedback from me and this channel, make sure to leave your comments below. I do go through all of them and approve them one by one, so I will see whatever it is you leave for me. And that's it. I want to keep this video on the shorter side. There were just a couple of key points to cover, and the rest we will allow to unfold. So with all that said, I'll let you guys go. Until we meet again, take care of yourselves, friends. Be kind to each other, and we will chat here very soon. Cheers, everyone.